Why is it that in a world overflowing with financial advice, most people still fail at investing? It's not because they're not smart enough, and it's rarely because they don't have enough money to start. The real truth is much simpler and far more uncomfortable. People fail because of their own behavior. They sabotage themselves with emotional decisions, bad habits, and mental shortcuts that feel logical in the moment but end up destroying long-term wealth. My name is Alex, and today we're pulling back the curtain on the psychological traps that quietly drain investors year after year, and more importantly, how you can avoid them. Let me start with a question. Have you ever bought a stock simply because everyone else was talking about it? That's the first trap, FOMO, or the fear of missing out. It's one of the strongest human emotions. Investors see others making quick gains, and they jump in late, often at the peak, only to panic when prices fall. Legendary investor Warren Buffett summed it up perfectly when he said, "Be fearful when others are greedy and greedy when others are fearful." Most people do the opposite. But why is that? And more importantly, how can you train yourself to resist that urge? Stick with me because the answer isn't what you might expect. Here's another common mistake: overtrading. Many beginners believe the more they trade, the more money they'll make. The reality, research from Dalbar, a financial analytics firm, shows that the average investor consistently underperforms the market, sometimes by several percentage points annually, because they jump in and out too often. They chase trends, switch strategies, and end up buying high and selling low. Think about that. The very activity they believe is helping them grow wealth is actually the reason they're falling behind. So, why do people keep doing it? The surprising truth is that the human brain craves action. Doing nothing feels wrong, even when doing nothing is often the smartest choice. Now let's talk about risk, the concept most investors misunderstand. Many think risk simply means volatility, those ups and downs in the stock market that make headlines. But true risk isn't about short-term swings. It's about the permanent loss of capital. Peter Lynch, the legendary manager of Fidelity's Magellan Fund, once said, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." In other words, the real danger is not volatility, it's making poor choices because of it. So, how do you protect yourself from confusing noise with actual risk? The answer lies in a simple mental shift that we'll uncover shortly. Another trap is the illusion of control. Investors believe that if they just research hard enough, read enough articles, and time their trades carefully, they can predict the market's next move. But here's the reality. Even the world's best professionals admit they can't consistently predict short-term market movements. Howard Marks, co-founder of Oaktree Capital, wrote, "You cannot predict, but you can prepare." Yet many amateurs still believe prediction is the key. That belief leads to frustration, overconfidence, and eventually financial losses. So if predicting isn't the answer, what is? Let's pause for a moment and look at an even deeper issue: emotions. Fear and greed drive most investment decisions. And unless you build systems to counter them, they'll keep running the show. In fact, behavioral finance studies reveal that the pain of losing money is felt about twice as strongly as the pleasure of gaining it. This explains why so many investors panic sell in downturns and miss out on recoveries. Imagine jumping out of a roller coaster the moment it drops. You'd never experience the thrill of the climb back up. But what if you could rewire your brain to handle those drops calmly? Is that even possible? Yes, and the solution lies in creating rules for yourself before emotions kick in. For example, automatic investing strategies like dollar-cost averaging. Remove the decision-making process altogether. You commit to investing a set amount regularly, regardless of market conditions. Over time, this not only builds discipline, but also ensures you buy more when prices are low and fewer when prices are high. The question is, why don't more people adopt these simple, proven systems if they work so well? Here's the twist. People crave excitement. They want to feel like they're doing something special, finding the next Tesla or Amazon before everyone else. But this desire for excitement leads straight into speculation rather than investing, and that's one of the biggest reasons people fail. True wealth building is often boring: steady contributions, consistent discipline, and patience. Yet boring is what works. Charlie Munger, Buffett's longtime partner, said it best: "The big money is not in the buying and the selling, but in the waiting." So now the big question: how do you train yourself to embrace the boring strategies that work and avoid the flashy distractions that don't? Stay with me, because in part 2, we're going to break down the practical steps you can take to sidestep these traps, rewire your thinking, and finally invest like the pros. So, how do you actually put this into practice? The first step is building self-awareness. You need to recognize your own biases before they control you. For example, ask yourself, am I buying this stock because I've researched the company thoroughly, or just because everyone on social media is talking about it? That simple pause can save you from countless mistakes. Next, use systems to protect yourself from impulsive decisions. Automatic investing tools are powerful here because they eliminate the temptation to time the market. By setting up automatic contributions into index funds or ETFs, you essentially build a wealth machine that runs in the background, requiring no emotional input from you. It's not glamorous, but it works. But let's go deeper. What about those moments when markets crash, headlines scream doom, and your portfolio is bleeding red? This is where most investors throw in the towel. Yet historically, those downturns often become the greatest opportunities. Remember the 2008 financial crisis? Investors who held steady, or better yet, bought quality companies during the panic, saw extraordinary gains in the years that followed. The lesson is simple: downturns are temporary, but selling in fear can make your losses permanent. The real winners are the ones who stay calm when everyone else panics. Still, staying calm isn't easy. So here's a practical trick. Reframe market downturns as discounts. When prices drop, imagine the stock market as your favorite store having a massive sale. Would you run out of the shop, or would you look for bargains? This mental shift helps you see volatility as opportunity, not danger. Now let's address another big reason people fail. They never define their goals. Without clear goals, investing becomes random, and random rarely works. Are you investing for retirement in 30 years? For a house in 10 years? For passive income along the way? Each goal demands a different strategy. Without clarity, it's easy to chase shiny objects and lose focus. Howard Marks once wrote, "You can't do the same thing as everyone else and expect to outperform." Defining your goals gives you a compass when everyone else is just drifting. Another critical point: risk management. Too many investors bet too much on a single stock or sector, convinced it will make them rich. But as Buffett reminds us, never put all your eggs in one basket. Diversification is the closest thing to a free lunch in investing. By spreading your money across industries, geographies, and asset types, you protect yourself from one bad decision sinking your entire portfolio. And here's something most beginners don't realize. Sometimes the best decision is not investing in a company at all. Avoiding bad investments is just as important as finding good ones. Think about it. If you lose 50% on one investment, you need a 100% gain just to break even. Protecting your downside is often the most overlooked secret to long-term success. So let's tie this all together. Most people fail at investing not because they're unlucky, but because they let emotions, impatience, and poor habits dictate their choices. They overtrade, they chase hype, they panic during downturns, and they refuse to stick to boring but proven strategies. The good news? You don't have to repeat their mistakes. By building self-awareness, automating your discipline, reframing volatility, setting clear goals, and protecting against risk, you position yourself in the small minority of investors who actually succeed. Here's the final takeaway. Investing success isn't about brilliance, secret formulas, or predicting the future. It's about mastering yourself. Warren Buffett once said, "The most important quality for an investor is temperament, not intellect." If you can control your behavior, you've already won half the battle. So let me leave you with a question. Are you ready to stop sabotaging your own investments and start acting like the disciplined, patient investor who actually wins? Because the truth is, the only thing standing between you and real wealth is you.